this first section, we will cover the introduction to Irish value-added tax, introduce you to the history of Irish VAT, explain the definition of VAT, provide an overview of the Irish value-added tax system, and explain the purpose of VAT. Value-added tax plays a crucial role in the Irish economy by generating revenue for the government and promoting economic policy objectives. Understanding the basics of the Irish VAT system is essential for businesses operating in Ireland, as well as for consumers who want to understand the tax implications of their purchases. Ireland introduced value-added tax in 1972 as part of its membership in the European Economic Community. This was a major change in the Irish tax system and marked the country's integration into the European Union's VAT system. Since its introduction, the Irish value-added tax system has undergone several changes and amendments. For example, in the 1980s, the government reduced the VAT rate from 25% to 20% to stimulate the economy, and in the 1990s, it increased the VAT rate to 21% to help fund public services. Value-added tax has played an important role in Ireland's history since its introduction in 1972. The standard rate has been increased several times to help fund the government spending and to ensure the long-term stability of the country's finances. Despite the controversy surrounding some of these changes, VAT remains a key source of revenue for the Irish government, with a standard rate of 23%. Over the years, the Irish value-added tax system has become more complex, with different rates applied to different goods and services, and a growing number of exceptions and exemptions. In recent years, the Irish government has introduced several measures to reduce VAT fraud, such as requiring businesses to register for VAT if their taxable supplies exceed a certain threshold, and requiring them to submit returns electronically. Today, value-added tax is a critical component of the Irish tax system and a significant source of government revenue. Businesses operating in Ireland must understand the VAT system and comply with their VAT obligations to avoid penalties for non-compliance. The Irish VAT system operates on a self-assessment basis, where businesses collect VAT on behalf of the government and periodically submit returns to Revenue, the Irish tax authority. In this section of Introduction to Irish VAT, we will cover the definition of value-added tax, with some examples. Value-added tax is a broad-based consumption tax that's levied on the value added to goods and services. It's applied to most goods and services purchased for use or consumption within the EU. Exported goods and services sold abroad are typically exempt from VAT, while imports are taxed to ensure fairness for EU producers, allowing them to compete equally on the European market with non-union suppliers. Value-added tax is a general tax that applies to all commercial activities related to goods production, distribution, and services provision. However, businesses with an annual revenue below a specified limit, which varies by member state, are exempt from charging VAT on their sales. Value-added tax is a consumption tax because it is borne ultimately by the final consumer. It is not a charge on businesses. Value-added tax is charged as a percentage of the price, making the tax burden transparent at every stage of the production and distribution process. Value-added tax is collected fractionally through a system of partial payments. Taxable businesses, who are registered for VAT, deduct the amount of tax paid to other businesses on purchases for their operations from the VAT they have collected. This process ensures that the tax remains neutral, regardless of the number of transactions involved. How value-added tax is charged. The VAT owed on a sale is a percentage of the sale price, and the taxable person can subtract the tax paid at previous stages. This prevents double taxation and ensures that tax is only levied on the value added at each stage of production and distribution. The final VAT paid is made up of the sum of VAT paid at each stage, as the final price of the product is the result of the cumulative values added at each stage. VAT-registered businesses are assigned a number and must display the VAT charged to customers on invoices. This allows registered businesses to know the amount they can deduct and consumers to be aware of the tax paid on the final product. As a result, VAT is properly paid in stages, and the system is partially self-regulating. The following example demonstrates how value-added tax is charged. Let's say a customer wants to purchase a product for €100. With a VAT rate of 23%, the VAT amount owed on the sale would be €23. Therefore, the total price of the product, including VAT, would be €123. VAT is a common type of tax in the European Union and many other countries around the world. VAT rates vary between countries, but the standard VAT rate in most EU countries is around 20%. In some countries, reduced VAT rates are applied to certain goods and services, such as food, children's clothing, and essential medicines, to make these items more affordable for consumers. VAT is an efficient and effective way to generate revenue for the government, as it is collected at each stage of the supply chain, rather than just at the point of sale to the end consumer. VAT also promotes fairness in the tax system, as businesses can only offset the VAT they have paid against the VAT they have collected, meaning that businesses that do not participate in the supply chain do not benefit from the offset. In conclusion, VAT is a tax levied on the value added to goods and services at each stage of the supply chain, from production to consumption. VAT is an indirect tax that is collected and remitted to the government by businesses, and is based on the principle of taxing the value added at each stage of the production and distribution process. Understanding the definition and principles of VAT is essential for businesses operating in countries that have a VAT system, as well as for consumers who want to understand the tax implications of their purchases. In this section of Introduction to Irish VAT, we will provide an overview of Irish value-added tax system. Ireland has a well-established value-added tax system, which is designed to tax the value added at each stage of the supply chain. The VAT system in Ireland operates in accordance with the European Union VAT Directive and is governed by the Irish Revenue Commissioners. VAT is a tax levied on the sale of goods and services, with the end consumer ultimately responsible for paying the tax. However, each party in the supply chain acts as a VAT collector, collecting VAT from their customers and reporting it to the revenue. They can also reclaim VAT charged to them by their suppliers when filing their VAT return. VAT in Ireland is charged at different rates depending on the type of goods or services being sold. The standard rate of VAT is 23%, although there are also reduced rates of 13.5%, 9%, 4.8%, and 0% for certain goods and services. In addition, some goods and services are exempt from VAT, such as certain health and education services. Businesses registered for VAT in Ireland must submit VAT returns on a regular basis, typically on a quarterly or monthly basis. The VAT return shows the VAT collected from customers and the VAT paid to suppliers, and any difference must be paid to or claimed from the revenue. The Irish VAT system is designed to be straightforward and easy to understand, and the revenue provides guidance and support to businesses to ensure they comply with their VAT obligations. However, businesses must take care to ensure they are correctly applying VAT to their transactions and correctly reporting their VAT obligations. In conclusion, the Irish VAT system is an important part of the Irish tax system and provides a significant source of revenue for the Irish government. Businesses operating in Ireland must ensure they are fully compliant with their VAT obligations to avoid any penalties or interest charges. In this section of Introduction to Irish VAT, we will cover the purpose of VAT in Ireland. The main purpose of value-added tax in Ireland is to generate revenue for the Irish government. The revenue generated from VAT is used to fund various public services, such as healthcare, education, and infrastructure. In addition to generating revenue, VAT is also used as a tool for economic policy. For example, lower VAT rates can be applied to certain goods and services, such as food and children's clothing, to make these items more affordable for consumers. Conversely, higher VAT rates can be applied to luxury goods to discourage excessive consumption. Promoting fairness in the tax system, VAT also promotes fairness in the tax system, as businesses can only offset the VAT they have paid against the VAT they have collected. This means that businesses that do not participate in the supply chain do not benefit from the offset, and the burden of the tax is placed on those who do participate in the supply chain. Encouraging economic growth, VAT also plays a role in encouraging economic growth, as it incentivizes businesses to increase their sales and profits, which in turn increases the revenue generated from VAT. VAT also provides businesses with a mechanism for recovering the cost of their inputs, which can help to reduce their overall cost structure and increase competitiveness. In conclusion, VAT plays a crucial role in the Irish economy and is a significant source of revenue for the government. The purpose of VAT in Ireland is to generate revenue for the government, promote fairness in the tax system, and encourage economic growth. Understanding the purpose of VAT is essential for businesses operating in Ireland, as well as for consumers who want to understand the tax implications of their purchases.